think it's 11 o'clock and we should get going. There's a bit to run through this morning. I'm going to have a look at some news. I'm going to hand over to Richard then, who's going to talk about something as well. And then he's going to be interviewing Stephen Inglis of Regional REIT. Should be quite an interesting chat, I think. So, bits of news that I picked out. So we finally have a sort of a new IPO. Well, there is one still ongoing, the 8085. We're still waiting to see what the outcome of that's going to be. But Ashoka WhiteOak Emerging Markets is pressed the button on trying to float. We had some results this morning from GCP Asset Backed. I thought I'd have a quick look at those. And then, as I say, Richard's going to be talking about the Industrials REIT bid. With Ashoka, so it's just published an intention to float, and it's looking for £100 million. It's going to be open to everybody. So there's a placing for professional investors and an offer for subscription and an intermediaries offer for retail investors, which we obviously think is good news. The manager, you'd know because it manages Ashoka India Equity. We'll talk a bit about that in a second. It's got about $5.5 billion under management altogether now. And it's the same sort of style as it's using for Ashoka India Equity. So well-managed, scalable businesses with superior returns on capital. Attractive valuations is the sort of tagline. Well, sort of. And the same manager, Prashant, will be sort of leading the charge on this, although he has got two co-managers alongside him. And there's quite a big team, actually, with Acorn. It's one of these things that I always sort of was curious about, how they managed to make a big team, given the way that they run their fees. We'll come on to that again in a minute. Quite a diverse portfolio, so 100 to 200 positions. That's more than most, I think, in this kind of sector. And it's sort of some flexibility around what we can invest in, but really only sort of, that's at the edge, really. I'm not sure it'll be going up to 10% in any of those things. I suppose the only one that would make most sense would be frontier markets, places like Vietnam. The prospectus will be out on the 18th of April. And you'll have to apply by the 27th, 28th if you're interested. And then, if all goes well, it'll start trading on the 3rd of May. So it's being done off the back of the success of Ashoka India Equity, and it has been a real success. So launched at £1, now £1.80. It's beaten its benchmark by about 39%. I think it was up to the end of March. It's trading quite close to NAV, as you can see there on the line, and it has done more since launch. And it's now up to 203 million market cap. It started off at just 50, so that just shows you how well it's done, really. So the Emerging Markets Fund is going to have the same fee structure as Ashoka India Equity. So there's no base management fee. And it's all basically funded on the back of the performance fee, which is based on performance relative to MSCI Emerging in this case. I'm assuming, until we get the prospectus, we don't know for sure, but assuming it's exactly the same structure as AAE, so that would be, they take 30% of the outperformance over 3-year rolling periods, capped at 12% of time-weighted average assets, which sounds like a lot because it could be a lot. I think that's the point. So I crunched some numbers here to see what actually they've earned out of this so far. So by the time they got to the end of June, so this thing was launched in 2018, about the year before, they'd only accrued £52,000 in fees. And this is where I said I was slightly worried that they wouldn't be able to afford to keep it going. But because the performance was so good in subsequent periods, those numbers did pick up quite a bit. So 2.8 million by the end of June 2020, 5.1 million for June 21. But then they haven't accrued anything since. We don't know what the number will be in June 23 yet, obviously, but at the moment there's nothing in the bank for them. They did get paid out £7.9 million in June 21, so they're not exactly short of cash. But I think with these sort of fee structures, it's totally up to you whether you think it's okay or not. I get the incentive element of it. I get why it might be attractive I would think it would be better to have a mixture of a smaller base fee and a smaller performance fee, perhaps. Crunching my numbers, I reckon had they just charged 1% no performance fee, then up to the end of December 22, the total fees on the fund would have been 5.6 million. It's a very rough number. So they've earned more than that, but then they have performed very well. So maybe you think they deserve it. I'm going to meet them next week anyway, so I will report back some way or another, probably not here, but maybe on a City article, or maybe we'll do a QD view or something on the back of it, just to give a bit more information. GCP Asset Back now. I quite like this fund, but it has struggled since rates began to rise, and it had a few portfolio problems that have unnerved people, I think, and the NAV's come back a bit, and as you can see, the share price has come back a lot more, so there's a big discount opened up. And the NAV has gone down over the accounting year that they've just reported on, so down about 5p, or almost 5p. The dividends edged up a bit, and they have managed to keep the dividend climbing. It's by no means matching inflation, but nevertheless, it is still going up, which is not bad for a debt fund, really. The things that hit them were the write-down of a co-living loan. We'll talk about that a bit more in a second. Some social infrastructure stuff. They also lost their lead manager, and I think that unnerved some people too. And in response, because the discount's been wide, the board has been quite good about buying back stock. And that's obviously, I think, a good call for them. So they bought back 12 million shares since 14th of October, when things got really sort of unnerved by David's departure. The co-living stuff, it was just too big a position, really, in retrospect. So they started off by lending these people 5 million quid, and it was against against spaces that looked a bit like student accommodation, but were designed for people that needed accommodation fairly close to London, really, or big cities in the States, and were prepared to sort of compromise a bit on the sort of space that they had in their flats in exchange for some sort of communal living spaces. It was a fairly good idea, I think, but it hasn't really worked in terms of what happened to it with COVID. So when they breached their covenants, the natural thing was to try and sell the whole company and see trying to get the money back that way. That didn't really work, so they tried spinning out some co-living assets. There was a brief plan to launch a REIT on the back of this that didn't fly. So they've just been writing it down, and there's quite a big write down over 2022 again. So it's only now £4 million to the portfolio. You can see the reasons for that write down there. Most of those things probably not reversible, so that there might not be much more recovery to come. But there you go. I think that's sort of a lesson learned from that. Wasn't a pretty good idea. On the social infrastructure side, they've had these problems with these multi-use community facilities for a while, since COVID. Basically, it's a sort of mix of retail and leisure, and it's sort of struggled a bit as a concept. They're trying out a new operator for the largest asset of the two that they've got. Whether that works or not, we don't know. There has been some recovery in operations, they say, since COVID, which I suppose has been encouraging. They've also got some exposure indirectly to MySpace housing, which we know has been a problem for people like Triple Point, and to much lesser extent Civitas. This is one of the registered providers of social housing. It's run into problems. The regulators clamped down on it. The properties they've lent against only account for 1.5% of Gary's portfolio. Obviously, the properties are still there, and this is the whole point about the asset back thing. They're supposed to be able to try and get the money back again. MySpace has not been paying rent, so the person who is owning the properties has been receiving the income, and that's obviously affecting their ability to pay rent to GCP Asset Backed. Not great, but I think it will get sorted out maybe quite soon. On the management side of things, they've decided that they're just going to keep the temporary team they've got in place as the permanent co-managers, so Joanne and Philip Kent. We know Phil quite well because he does GCV infrastructure too. Obviously, that means he's quite busy. So I think Joanne would maybe sort of take a bit of the lead on this. We did talk to David Collin and Joanne on our show on the 8th of July. So if you want to listen back to that, that's sort of a bit more about the fund. But what I think is, since that's almost a year ago now, what we'll do is we'll try and pencil them in the summertime and catch up with where they are. There is a wider team there, and they are trying to recruit another body. I'm not too worried that they haven't got the people to run this, but it would be better to have somebody dedicated. And then in terms of portfolio, I do think it's sort of looking a bit better. So the annualized yield of the existing portfolio is 8%, but the new stuff that they're writing is 8.6. So obviously rising interest rates do eventually flow through to their income, and that's good news. They've got a sort of weighted average expected term of 6 years on what's in the portfolio now, which is good. They used to get a lot of prepayments because obviously as interest rates were falling, then their loans were progressively more expensive. As things are going the other way now, I think they might try up a bit, which dents the income a bit because the prepayment income was quite helpful. It's sort of extra bit of income. They're not too worried about the property in the state of this economy. So property loans, the LTV is about 70%, which is not too bad. I mean, obviously people taking mortgages at 95, that sort of thing. There's 50 loans in the portfolio now, 9 of those against assets under construction. That's normal for them because that's how they get the NAV uplifts, and how that helps sort of keep the dividend going up as well. And they're valued on a weighted average discount rate of 8.4%. That's up from 7.5% at the end of 21. So I don't think it's too bad, really, although it's had a sort of bit of problems with the portfolio. I do think actually maybe this is looking interesting now on this discount. That's what the portfolio looks like now. It is got a really broad spread of stuff. Some really interesting, innovative stuff in there as well. Football finance is a weird one for one. They talk about that a bit in the results because there's a 0.5% loan where actually that's sort of slightly run into problems, but they think that's completely manageable and they will get the money back. Yeah, I think it's worth a closer look if you've got the time. So that's enough for me. I'm now going to hand over to Richard, and probably he'll share his screen rather than mine.
Hi, yeah, thanks, James. I'll just put this into full screen mode. There we go. Right, yeah. So as James mentioned, and it was announced a couple of weeks ago, there's a deal for Industrials REIT to be taken private by Blackstone. They've agreed terms now. It's announced this morning, 168p per share, which is a massive premium to when it was announced early April, of 42%. And they've announced today that that's going to be a material premium to their end of March NAV, which is yet to be announced. So really interesting, especially at this time in the property sector where values are being sort of questioned, that this deal will come about. It needs at least 75% of shareholder support. The board is recommending it, and it will vote in favour of its shares. And it's announced that it's also received letters of intent from other shareholders representing 22. So they've got about almost 30% already, and I'm pretty sure it will be voted through, and we'll go through. It'd be a shame to lose them from the listed world. I know them fairly well. They were established in 2012, formerly called Stemprop. They had a lot of properties all over Europe, including some in the UK. In 2017, they bought a multi-let industrial portfolio, and just put all their sort of eggs into that basket, really. So announced that they were going to change their strategy and become 100% focused on multi-let industrials in the UK. That completed just last week, actually, when they sold their final asset, which was a care home portfolio in Germany. That finally completed. So they're 100% now focused on UK multi-let industrials. Portfolio worth 650 million. Interesting announcement for the end of 2022, talking about how their rents are going and stuff. So passing rent over 22 was up 5%. On new lettings and the renewals within the portfolio, they were up 31% on the previous passing rents, which is pretty impressive. Estimated rental value was also up 10.5% over the year. So just showing that the supply and demand dynamics in this sector are still really strong. And what really sets them apart for me from the others is their Industrials Hive sort of online platform, their use of technology, setting that up, streamlining new lettings, taking out the sort of the long legal time periods that it can take to set up a new letting, bring that all the way down so void rates are lower, and just driving through growth in rents really. That obviously attracted Blackstone and a lot of others. And you'd think that with this deal 40% ahead of the price, it would have an impact across the sector really, just showing that actually the values the values that the market are putting on these companies are way too low. So I'll put a sort of list together here. Industrials wasn't in the AIC category, so it won't be on here, but here's the UK commercial, and then at the bottom I've tagged in the UK logistics as well, and just show the discounts that some of these guys are on, and they're pretty hefty. And we've also got regional REIT coming up, that's 30%. We've obviously talked to Stephen about that, but Eddiston, you might remember a few weeks ago, pretty much called time on there, that they're looking to merge with another REIT or be sold. They're on a 16, obviously that's come in since they made that announcement, but they were up at around sort of 20-30% as well. And if it carries on like this, I can see a lot more of this, these deals happening, sort of take private deals. So yeah, there's a sort of nice segue in there to get Stephen on.